Welcome back. We're about an hour away from the opening bell for a Thursday. Markets are higher. Take a look at the NASDAQ. The highlight this morning up 264 as the NASDAQ and big tech bounces after several sessions of decline. The NASDAQ up about 1% right now. Interest rates this morning, meanwhile, look like this. We've been looking at yields this morning, and they are higher once again, with the 10-year sitting at 4.58%. The Federal Reserve releasing the minutes from the June meeting yesterday, the first under new chairman Kevin Warsh. Federal Reserve officials were split on the direction of interest rates as they were left unchanged in that meeting. Warsh called the debate a family fight. The dot plot is suggesting a rate hike this year, followed by rate cuts over the following 2 years. We've got key inflation data also out next week. The June Consumer Price Index is out on Tuesday, and the June Producer Price Index is out on Wednesday. Joining us now is MacroMavens President Stephanie Pomboy. Stephanie, great to see you. Thank you so much for being here this morning. I want to get your assessment of what you heard out of the minutes from the Fed and your outlook for next week's inflation data.
Well, thank you for having me, Maria. I think the minutes of the Fed were not terribly surprising, given what we heard from the comments immediately after the meeting. Clearly, some kind of split view on the inflation outlook, although it seemed pretty clear that they were inclined to look through the current inflation uptick as really an energy-driven phenomenon, and that was going to dissipate. And obviously, the events of the last 24 hours have probably changed that calculus somewhat. And the Fed did go to great lengths, at least in this conversation they had around the table, to point out their concerns about inflation expectations becoming entrenched because the Fed has allowed inflation to run above its target for so many years post-COVID that, people are starting to lose confidence that they're ever going to actually get it back down to 2%. So all that being said, I think it's highly unlikely that the Fed actually raises rates this year. If anything, their stance right now is accommodative because in the background, their balance sheet is expanding to the tune of roughly $600 billion a year. So they're doing QE, even though they're not calling it QE. So, the notion that they would raise rates on one side and expand the balance sheet on the other is actually the exact inverse of what Kevin Warsh suggested he wanted to do, which was lower rates and shrink the balance sheet. So all in all, I think probably Fed policy on hold for the time being for the rest of the year.
I think I agree with that, actually. Tiana, what do you think?
No, and so I know there's been this discussion about what is going to be the role of AI in inflation.
Yeah.
Nick
Timrose wrote about that from the Wall Street Journal. Yeah, he told us about it earlier.
And clearly that's what those FOMC minutes were indicating. But the IMF just came out with their global growth and inflation projections, and they say that the U.S. is projected to grow 2.3% this year. That's up from 2.1 last year. That's more than double what the Eurozone is projected to be. And they're attributing that to AI. So does AI have more growth potential at this point than inflation potential, even in the short term?
Well, it's an open question. I mean, I guess we'll find out during this earnings season whether we're actually beginning to reap the productivity benefits that AI has promised, and I think analysts will be very carefully scrutinizing those earnings reports from the likes of Amazon, Meta, Google, et cetera, to see if they're actually flowing down those productivity benefits. But, one presumes it would take a while for that to materialize, and that in the near term, the increase, the stimulative aspect of CapEx to growth would be more inflationary. And in fact, next week, Maria, with the inflation numbers, the PPI is still expected to run, 0.4%. Which is a solid, 4.8% annual rate. So the PPI is now running ahead of, that's input prices are running ahead of consumer prices, which reflects this demand for, CapEx materials related to CapEx, et cetera.
Which I think is important to identify, because that means that the producers are eating the cost. And so far, they haven't passed it on to the consumer because the CPI is not keeping up with the PPI. But let's get to the jobless claims. The data is just hitting the tape, and Cheryl Castoni has it. Cheryl.
It is better than expected. More signs that we've got a very stable, maybe strong jobs market. I think it's fair to say that. that 215,000 less than expected. The expectation was 218. Continuing 1.814 million. The expectation was above that, 1.815 million. Also, the 4-week moving average is moving down. That is a positive. We're averaging about 92,000 jobs created each month, Maria. You know, on a broader story here, we had net losses last year for jobs. So again, you know, this low hire, low fire environment is what we're seeing. Again, these numbers back that up once again. And to your point with Stephanie about an accommodated Fed, employment is one of their 2 mandates at the Federal Reserve. And right now, the data looks fairly stable, Maria.
Yeah. You know, the Social Security Trust published a report noting that Social Security benefits will need to be reduced by 25% by 2029 as funds are being depleted. That obviously has a real impact on deficits. And I want to get your take on the broader issue. Cheryl, thank you for that. We haven't seen a big move in the markets after the continued jobless claims and the jobless claims numbers that you just reported. Cheryl, your reaction, Stephanie?
Well, I think to describe the labor market as stable is probably the best descriptor. You know, we had another very kind of murky payroll report in terms of the payroll number, you know, not a little disappointing, but the real staggering number was the collapse in the household survey. And so those 2 surveys continue to send different messages. And what I will say, you know, while it's hard to get a firm grasp on what the actual job creation is, the quality of the jobs clearly leaves something to be desired because we continue to see stress in terms of consumer credit quality. You know, that has not abated, which is actually a little disturbing given this run up in asset price, financial assets, but also the tax refund windfall. So I think, you know, that's something to watch and be mindful that, you know, the employment numbers, we may be creating a decent quantity of jobs, but we've really got to start to scrutinize the quality of those jobs. And I know there's hope that the AI CapEx boom will create a lot of jobs, but that's you know, a fairly narrow sliver of the population that can do that work. So,
Stephanie, real quick before you go on earnings, what are your expectations for earnings period?
Well, I mean, this promises to be an incredibly strong earnings quarter, but really paced by 2 sectors, not surprisingly, tech and energy. I think tech earnings are supposed to be up 60+% in the quarter, spectacular, and energy up 120. You know, if you strip that away, the overall S&P earnings number is going to be around 11% growth for the quarter, which is still nothing to sneeze at. The question, as you alluded to, is sustainability. And, you know, when it comes to this pricing pressures with input prices really stubbornly high and the ability to pass them on, you know, looking a little compromised, we'll see what happens for margins in the consumer-facing sectors, which have already been sort of under pressure. And to me, you know, ultimately, this economy is driven by the consumer. Right. So we can sustain a CapEx boom only so far. Ultimately, you know, the consumer has to kick in. And as yet, I know everyone's excited about the numbers they see, but we've been living in a tax refund windfall period that's now over. So the burden of proof is now, now that the refund season is over. And we'll watch those retail sales numbers very carefully next week.
Stephanie, great to see you. Thank you. Stephanie Pomboy joining us. We got robotics on the other side of this break. Stay with us.